Keith, thanks so much for your time. So small caps, the buzzword right now on the markets, but perhaps a general discussion on exactly when we say small caps, what kind of companies are we talking about, the size?
So there's no legal definition, but in terms of market rules of thumb, it's companies with market caps less than about $1 billion globally. So it's quite big. In South African context, that would be about 12 to 15 billion rand and down. That said, the JSE also has very different demographics, where we have the top 40, and generally speaking, anything outside of the top 40, we refer to as small and mid caps, and they're interchangeable terms, more or less, because the sizes aren't that different.
Mm-hmm. I mean, in terms of investing in small caps, perhaps you can make a case for why we should be looking at them. I mean, many people say that they're a lot riskier, they don't pay out as much dividends as the big cap stocks. Why small caps?
So I'll summarize the argument, and there's plenty of aspects to it, but in a nutshell, in the long term, small caps generate a higher return than the larger, slower moving, slower growing blue chips. And the other aspect of it is that if you have a look at the market size, particularly on the JSE, about 73% of the entire market cap is made up of the top 40. But the top 40 is only 40 companies. In fact, 90% of listed individual companies on the JSE are outside of the top 40. So on the one hand, you want to invest in small caps with a long-term perspective because they provide superior growth. On the other hand, if you're not looking at them, you're technically ignoring 90% of the market. So there's an element where there are business models and there are companies that operate in this part of the market that just quite simply aren't in the top 40. Sure. So you're ignoring 90% of the market, you're ignoring a potential to diversify the portion of your equity returns.
Sure. All right, so let's talk about some of your picks. Adapt IT, why should we look at this?
So Adapt IT is one of the few listed tech companies in South Africa that is rich in intellectual property, IP. It's not a service business, it's not a hardware business. Adapt IT is a software business, and the beauty about software is really the scalability of it. I can take once the software is built, I can sell it to one person, 1,000 people, 1 million people. In Adapt IT's case, it's business to business, so those customers and the clients are always businesses, but it costs me nothing more. The marginal cost of the sales is very low. On the other hand, on the other side of the equation, the cash flow is very powerful. So once the software is built and is out there and installed, the software cycle you tend to bill up front. And think of software licenses or cloud-based payments. They tend to happen before you actually use the software. In other words, the money's in Adapt IT's bank account and then it provides the goods and services.
Sure.
So the cash flow cycle is very, very attractive. And then the really big picture is that it's very fast growing. Tech is obviously fast growing, and within the subsect of tech, there is software is actually, in fact, the fastest growing portion of it. So Adapt IT, as it scales up and slowly brings in other IP into its fold, it can internationalize at a very, very low cost. It can on-sell its software very attractively. It's very, very cash generative, and at the same time, it's growing 10-20% year on year naturally.
But what about the risks for that expansion and those returns? What are we looking at?
Absolutely. So your risks in the software sense is building the software, whether because you incur the cost right up front, and then you've got to sell it. Adapt IT isn't a venture capital company. It only buys commercially viable software with a proven client base. So your risk inherent in Adapt IT is not that venture capital risk. Your risk is the execution of their strategy. In other words, they make a bad acquisition, a software product they have built or service becomes technologically obsolete, perhaps something better comes out, perhaps a competitor builds it better, perhaps the customers or the clients they service go under. And then in the internationalization or globalization of the business is that they fail in doing it. They don't cross-sell, upsell, or on-sell the software into different markets, different niches, and they don't capture different client bases, which doesn't necessarily mean the business fails, but it may not justify the valuation.
Sure. Now, Master Drilling, I do know that they are at the mining in Daba, which is currently underway in Cape Town. Tell us a little bit more about why you're looking at these guys.
Master Drilling is one of those businesses that ticks every box when you look at it. It's got massive barriers to entry. It's got huge competitive advantages. So their core skill set is they provide raise bore drilling services to predominantly the mining industry. Now, those are not exploration drilling services. Those are production-orientated drilling services, predominantly for ventilation shafts. So in other words, they're trapped into the production cycle, which is much steadier. Now, they're not tied into the spot risk, but more importantly, the drilling fleet that they have is about 3 to 4 times larger than any global competitor they have. So they're globally dominant. Because these are mobile drilling fleets or drilling rigs, they can move them around the world, and they do. They already earn about two-thirds to three-quarters of their earnings offshore. They're not a South African company.
When you say they're not tied to the spot risk, are you talking about the commodity price volatility? Okay.
They'll get paid by the utilization of their drilling rigs. In other words, how many meters per day, at what pace, and depending on what project. And then in between projects, they'll pick up their rig and take to the next one. So their focus is on driving the utilization of their fleet. But in the background, you also start to appreciate that the scale advantage is not just their competitive advantage. It's the intellectual property that goes into the service and their fleet. So unlike many other drilling companies out there, they don't buy theirs off the shelf. They, in fact, have an integrated supply chain back to a company that they control in China, where in South Africa, out of Fookville, they design the fleet and manufacture it out of China, including the consumables, which are a very large portion of the cost of a drilling company, because obviously you go through the consumables. And all of that integrates into a globally competitive and dominant company in a space that is incredibly niche and unchallenged. And the beauty is the way the mining industry is shifting is an increasing focus on time sensitivity of projects, an increasing focus on safety. And their drilling service is cheaper, faster, and safer than any alternative, particularly a labor-intensive alternative.
And Keith, just a quick one, you get the Rand hedge element from Master Drilling as well?
Yes, a large portion of their revenues is in alternate currencies, most predominantly the US dollar currency. So they may be a small cap, and they own, by the way, only sitting on about a 7-8 times a multiple. So incredibly cheap for what you get. But they may be a small cap, but they're actually globally dominant in a very specific niche.